Good afternoon, everyone. We are now ready to begin the Life Insurance and Financial Planning Committee meeting. Thank you all for being here today. There's no need for a roll call. I will mark everyone's attendance. Good afternoon, everyone. I'm Carl Anderson, State Representative from South Carolina, and I will be chairing this meeting today along with the Vice Chair, Senator Mary, and we're just happy that all of you have decided to be a part of our meeting today. First, I ask for a motion to waive the quorum requirement. All right, it's properly moved in second. All in favor say aye. Those who oppose the vote nay. The ayes have it, and so it's ordered. Secondly, I ask for a motion to approve the March 10th, 2023 committee meeting minutes. It's moved. Second. All in favor signify by saying aye. Aye. Those who oppose the vote nay. The ayes have it. Well, let's start today with the discussion on the NCOIL Life Insurance is a Promise for Life Model Act. Ladies and gentlemen, this won't be much of a discussion, but rather more of a brief update since the sponsor of the model, Senator Holdman, wasn't able to be here today. You can view the model on page 268 in your binders and on the website and the app. Senator Holdman did ask me to report to everyone that since he was not able to be here today, and since there has been significant regulatory development on this issue among the states, he would like the model to be held at this meeting, and he would like to see how things develop over the next few months before moving the model further at our next meeting in November. And I know you're thinking, and y'all know I got a sense of humor, it may end up being that such regulatory activity reaches a level that makes the model unnecessary. And states that are interested in responding to this issue can utilize the resolution that NCOIL adopted on this issue as guidance. So for a brief moment, we will hear from Mr. Knapp. Please let him sit and give him the mic.
Thank you. Thank you, Mr. Chairman. It always is a true pleasure to appear before you and your committee. I'll keep it very quick. I was just asked by staff to give a quick update, which is just to give a little more detail on what you had said, Mr. Chairman. I represent the Life Insurance Settlement Association. The life settlement company's interest in this is that they see these enhanced cash value offers as unfair competition they're basically mimicking life settlements but not following the extensive consumer protections in the Life Settlement Act, and also violating basic life insurance pillars of the insurance code, such as the unfair discrimination prohibition and the standard non-forfeiture law smoothness requirement. We've presented on this multiple times and appreciate the opportunity and the interest of NCOIL very much. Very grateful for that. As you said, I think there's a pretty obvious correlation between NCOIL's interest and some substantial activities in the states. We now count 9 states that we're aware of that have taken some kind of action on these products, including 3 which recently have declared filings to have been in violation of the code. and have effectively rescinded those. We're continuing to meet with regulators and appreciate their willingness to kind of take a second look at the issue. They've been open-minded and have had good dialogue and discussions on that, and we'll continue to do that. And we appreciate, it's an important oversight review function that legislators carry out. And as I said, it's been terrific, the attention you've given to this since the fall of '21, and we really appreciate it. And a part of oversight is continuing to follow up, and we thank you for that.
Thank you, Mr. Nat. If there are any questions on this model, please reach out to Senator Holman, myself, or the NCOIL staff. Next on the agenda is a presentation on Minnesota's project to increase access to long-term services and support. With us here today is Mr. Steve of FTI Consulting. Mr. Steve, thank you for joining us. Please go ahead.
Thank you very much for having me. I'm honored to be here and pleased to talk about what's going on currently in Minnesota, and it's very convenient that you are meeting here in Minnesota as well, given that this project just began a few months ago. So as you heard yesterday from Assistant Commissioner Julie Marquardt, Minnesota does a lot of things well within health insurance, and they do a lot of things well in long-term services and supports as well. I'll refer to as long-term care and LTSS simultaneously. It means the same thing. But again, happy to be here. But as I kind of promised initially, that I would provide a quick update on long-term care insurance products, and usually you do that with sales. So the slide you see now takes you through the sales between 2021 and 2022. And when you look at the screen, just note there was a significant increase in sales in 2021 due to the Washington State program's exemption deadline in the fall of that year. So essentially, a Washington State fire sale happened. And at the top, you notice that sales were impacted by 37% more than usual for hybrid products in that year, and 118% more in the standalone space. So when you put those two, discount the Washington fire sale effect, the minus 22.4% increase in sales over 21 to 22 is actually a positive 13% increase. I think the industry, that fire sale had its own issues, and you can talk to me about that afterwards if you want, but not good for here necessarily. Furthermore, LIMRA surveys its members that are currently selling, so the numbers that come from LIMRA, and that's the Life Insurance Trade Association, doesn't really consider the in-force block as much. So I've updated that to include the NAIC Form 1 information, which has over 5 million of in-force standalone long-term care policies in the nation. You add that to the hybrid products, which are truly long-term care as well in many ways, and we're close to about 7 million policies in force today to dealing with through the private insurance market and through a slew of carriers. Now, one thing to take away from this slide, and it might be new to you and others in the audience, is that we're not just talking about standalone long-term care. We're talking about a plethora of ways people can fund their long-term care needs. Hybrid life insurance with long-term care, hybrid annuities, not summarized here, but there are hybrid annuity and long-term care products. There's also short-term care and supplemental benefit products as well, supplemental health products as well. A second observation here is you can see I calculated the average premiums in 2022. And for standalone LTC, that average premium was $3,737. In the hybrid space, around $7,500. Clearly out of the range for most in the middle mass. And so I wanted to bring that up as well, that yes, there's industry that's serving a population quite well here, but yet not reaching the middle mass. And hence the need for this work in Minnesota. So let me go on to that. One last observation about today's industry. So the industry is focused now on wellness, care coordination, and innovative product designs. In the past few months, there have been 3 or 4 new carriers entering the market with product designs and markets that differ from the past, including variable life chassis products, joint life solutions with long-term care, new carrier entrants with wellness incentives and programs that are baked in to the product. So encouraging people to stay healthy, stay well, stay in their home, and not need long-term care services and supports, which is what we all want, correct? So also including care coordination and support is a major focus now of the innovative products we're seeing today. And companies are implementing these for the in-force as well. It's not just for new business. But you may have also heard that there was once over 100 carriers selling standalone long-term care. All right, and there's only 12 left now. But let's drill down on that a little bit. And the second bullet up there talks about this. So according to Form 1 of the NAIC Experience Report, of the top 20 carriers with in-force long-term care policies, 14 are still actively in the market. They may have pivoted to hybrid products. They may still be in the standalone space, but 14 out of 20 still in the market. It's a pretty good number. And then when you look at the remaining policies, 80 of them have less than 10,000 policies. If you have less than 10,000 policies, were you really in the market, is my question. So then, with an average in-force of about 1,500 policy, so that means that 34 companies have 10,000 or more in-force policies today, based on the NAIC reporting form. So the notion that there were hundreds of carriers selling long-term care is just overstated or exaggerated. Yet some carriers attempted to sell long-term care policies, but ceased rather quickly for many reasons. Maybe distribution didn't appreciate it. Maybe they found another avenue for their clients. You know, the lackluster sales might have been just the client base that carrier particularly serves. And then some might have changed direction from a company that is working on individual to a company maybe working in the group space. So there's more than just that. And then finally, there's the impact of M&A. So I mentioned here the insurance product diversity, but there are other sources where long-term care needs are met. For example, on the bottom of the slide here, Medicare Advantage plans. There are 3,000 Medicare Advantage plans in the country, 500 of which cover adult daycare, transportation, and meals. MLTSS plans, Managed Long-Term Service and Support Plans, are managed acute and long-term care for the dual Medicaid populations. And half the states have such programs, with a lot of private insurers and companies, often risk-bearing entities for that care. And paid family medical leave. Minnesota just passed paid family medical leave during the last session. And that's a key solution for many folks out there. And then finally, there are significant community resources and waiver programs and Medicaid alternative care programs that help reduce that demand. All right, that was your update on LTC and industry. Let's talk about Minnesota and what we're doing here. Here in Minnesota, the Department of Human Services issued an RFP in collaboration with their Own Your Future initiative. This initiative has been exploring LTSS reform for over 10 years. And the goals, as you see on the slide, are to improve access to LTSS for Minnesotans that typically do not qualify for Medicaid, examining and evaluating integrated LTSS funding options, and then transforming the LTC funding system in its totality. The goal is to encourage simplicity, integration, equity, and accessibility of LTSS services. So Minnesota's work is right now about the process to finding that solution that's unique for Minnesota. Like I said, Minnesota does a lot of good things well in the health and the LTSS space, so they need to build upon that. We at FTI put together a 3-team approach with Alterum and Actuarial Research Corporation to help Minnesota DHS and Own Your Future campaign through this process. And we put stakeholders together to have comprehensive recommendations, which are due later this fall. And those stakeholders include the needs of individuals, families, caregivers, and the lack of caregivers, government programs, insurance programs, and other types of stakeholders, including consumer representatives. And so this stakeholder group, made up of Minnesotans who are knowledgeable and experts, are thinking about their friends, their neighbors, and their families in Minnesota rather than predetermined solutions. So it's been a very interesting stakeholder conversation for the last few months. And then simultaneously, there are additional projects underway that provide a deep dive into the data on LTSS and the need to enhance the caregiver supply and support. So the Minnesota Department is putting together a series of research studies that complement one another and look at various angles, including the lack of caregiver supply that's anticipated in the coming years. Those findings have each been very, very complementary of one another. So they're developing a set of implementable and vetted recommendations. We keep joking that this report's not going to get dusty, either virtually or physically, and it'll be ready to go come fall. But the key, as in each state, is because each state's different. Each state has different economics around their LTSS needs. They have different maturity in terms of how they deal with the Medicaid population, and this is specific to Minnesota. So, you know, many state legislators and offices of aging are starting with studies like this rather than just proposing options they've heard from afar and see if it'll play here. Public-private coordinated plans that were offered in the RFP for us to examine are on the screen now, and generally these ones generally fall under these categories, but the stakeholder group has actually gone in a different direction. You'll see that in a moment. But these four, you know, typical plan designs are kind of a back-end catastrophic plan, which kind of covers the risk beyond 2 or 3 years. And you might have heard that in something called the WISH Act, which was a nationally discussed endeavor to kind of replace Medicaid. Number 2 is a similar catastrophic plan, but focused on kind of a long-duration home and community support, so not as broad of a program. And then number 3 is an early intervention program that's similar to Washington Cares, that gets some funds in people's hands initially so that they're able to remain in the home stably. And then incentives to enhance the access to LTC insurance coverage. Well, what did this stakeholder group decide to focus on? This is where we kind of lightheartedly talk about the red box. It is red, by the way, up there. So what's the target population that they're really focusing on? So we took Minnesota's specific data, which covered the programs already present, to examine the populations that are least served, that are missing out, essentially, until they're qualified for Medicaid. And as you can see here, the middle income level has very few options. You know, they're to relying on private pay, they rely on one another for care, and there's little for this population to turn to when they need the care navigation supports. So, you know, think about this, think about yourself. If you had a care need or a loved one with a care need, where would you go? Who would you call? You'd probably call a friend. It'd be nice to have a care support, care navigation structure that the state might sponsor to enable people to find the care they need when they need it, to find the programs that can help them as well. So yeah, we call this the red box, as the slide says, and the goal is to keep many from departing that box, slipping into Medicaid. And the actions you see in the box so far for the Older Americans Act, the Medicaid early waiver programs, and alternative care programs are there to interject, kind of go upstream and keep the individual and the family from falling into Medicaid. So those are the waiver programs you hear about, the 1115s and so forth, that enable states to help reduce that demand on Medicaid. And here in Minnesota, they work very, very effectively. They're just not well known quite yet. So, you know, not looking to undo what's working well in Minnesota, but to build upon it and enable it to do more and integrate for the benefit of Minnesotans and the desire to reduce Medicaid reliance. I just want to highlight a few areas where Minnesota is doing a tremendous job on the slide here, and that's the partner agencies, the senior linkage line, and the MSHO program, where there are 8 carriers, some for-profit, some not-for-profit, that are doing those MLTSS programs, those Medicare and Medicaid dual eligible programs where someone gets a coordinated level of care. It's not about acute in one bucket and long-term care needs in another bucket. It's not about your hospital needs in one bucket and your facility needs in another bucket. They manage it together. And it works very effectively and keeps the heads out of the beds, if you will. It keeps them home in a stable and safe environment and a cost-effective environment. So they've been doing that for more than 25 years and have been very successful with that primary acute and long-term care service delivery. Why not the people in the red box? Why shouldn't they have the same type of care coordination structure? Now, the stakeholders did identify some areas of improvement by the stakeholder group, a strong need for LTSS education, I kind of mentioned that already, the historically underserved populations, the vulnerable populations. Yes, in Minnesota, there's a lot of rural populations as well as tribal populations too that tend to be underserved, and they want those to be addressed as well in a robust way. And then again, like I said before, technology, accessibility, the workforce are part of the solutions. And then finally, that caregiver support and navigation. Again, trying to go upstream with these interventions to keep people off of Medicaid. So what are some of those potential designs the stakeholder group has come up with? They focused on care navigation and supports more so than financing initially. Yes, the financing is critical, but yet having that care navigation and support structure is important. The need for educating family and friends and neighbors is even greater. And you know, the program Minnesota has in place works well, but needs to be better leveraged. So we call it senior linkage on steroids. So senior linkage is a great program reaching out to consumers, but it doesn't reach enough yet, or it's not, you know, so we're trying to enable that even further. Option one you see on the screen here is one of the potential designs that are under consideration by the stakeholder group is an early intervention and support approach where, picture this as a care navigation service or a website or an app where Minnesotans of all levels of need can get support. In the box, in the red box, above the red box, below the red box, I jokingly say behind the red box sometimes, trying to focus on all Minnesotans so they know where to go for support. That would include some type of informal caregiver training, access to programs that we discussed earlier, and even a marketplace for home and community-based services, and a marketplace for for long-term care insurance, short-term care insurance, or other kind of supplemental insurance products. So that's option one. Option two borrows from those MLTSS plans I mentioned earlier and tries to go upstream with that care coordination. And this one's important because, trying to tie the acute care needs and the long-term care needs together in a coordinated way is what people want. They don't want to be divided. They want to have one quarterback to go to for their assistance across the spectrum. Like I said, been very successful in Minnesota, also in Florida and California, and why not for the red box? But this can be accomplished with a supportive one-year benefit plan, which begins at like 60 or 65. You would purchase it at 60 or 65. It could be a mandated plan with some subsidies. For the non-Medicaid population, because why would you want to provide a mandated program when someone already has coverage through Medicaid? And there will be options to enhance and lengthen their coverage voluntarily. Other than the mandate to purchase, this design can be done today. No regulatory change in any state that I know of, and I've filed many products before across the nation, would have to change in order to bring kind of the Medicare side and the long-term care side together, and it would be portable as well. So nothing would have to change in insurance regulation, and it could readily increase the LTC insurance carrier supply as well, because you'd have individuals focused on both managing Medicare and their long-term care needs. And if they do it well, they can win twice. If they do it well, they can win twice. So finally, option three is the catastrophic coverage type plan that's similar to the WISH Act. It's intended to remove the Medicaid spend down for many in the red box. It removes it with a 2-year waiting period instead. Question, though, that the stakeholder group has on this is how does this integrate with Medicaid? And we're trying to find ways to resolve that so that the state is not turning away Medicaid funds from the feds, but finding ways to kind of reapportion them within the overall program. So, one thing to keep in mind here is that these are potential designs. They have options. Is it payroll tax funded? Is it premium funded? That's still yet to be discovered. It doesn't need to be that a payroll tax approach necessarily. It may or may not be employer or employee based. And then general revenue funding may be appropriate, or a blend of these approaches. But the goal is to find out what works for Minnesota, and with your state specifically, what would work for your state specifically as well. So my last slide is, how do we determine what works? And part of the RFP called for is an essential criteria. This is something that came out of the Class Act work about 12 years ago with the Academy of Actuaries and the Society of Actuaries. And we developed only 7 essential criteria elements back then. The stakeholder group in Minnesota came up with 11. So they added some good ones, some non-actuarial ones, which I was very pleased to see. And you can see up on the screen here, we have access, cost efficiency, benefits, sustainability, all the way down to the supportive side where if it's adaptable, if it's understandable, and if there's equity of access. In a state like Minnesota where you've got rural, urban, and tribal, you need to have equity of access. So what this does is it allows the stakeholder group to examine the totality of the LTSS system and say I have a proposed change like option 1 or option 2. And then they can evaluate how effective that option is. And so you get into a scheme of where you're not thinking about the best interest of those stakeholders, you're thinking about the evaluation of the entire system. So this framework works very well so far in comparing these options so that you can get to something that works extremely well. Now, we also asked them to evaluate the current system, and those scores you don't want to see. But going forward, the idea is that with these criteria elements in mind, can we improve the access for Minnesotans to the LTSS they really need? Particularly in the red box, but yes, applying to the entire population in total. So, like I said, our work is nearing completion. We anticipate a report by early fall. If you or your legislatures are contemplating similar proposals, keep in mind that a study is necessary to develop that recommendation, and it needs to be your state, specific. Every state is different when it comes to their Medicaid approaches and their LTSS approaches. And so having that unique study and not just borrowing from across the nation somebody else's program is essential. It's very important. That's all that I have, and happy to answer any questions.
Again, thank you, Mr. Steve. Are there any questions or comments from anyone around the table? Okay. Man, you did a great job. Again, we want to say thank you. There are many of us that are sitting around the table. You know, we got a few more years and we'll be at 6'5". You know, so we're grateful for the information and what you have done in Minnesota and sharing it with us. Thank you very kindly. This information also is online, so you can go back and watch what he has shown us. Next on our agenda is a discussion on a resolution opposing the return of a U.S. Department of Labor fiduciary rule, a resolution which I'm sponsoring. You can view the resolution on page 271 in your binders and on the website and app. The resolution is very straightforward and actually builds upon a resolution that NCOIL adopted back in 2016 when the DOL was in the process of developing a familiar fiduciary rule that was ultimately vacated by the courts. You can view the resolution in your binders on page 273 and in your binders and on the website and the app. Well, the DOL is back at it again. As you can see from both resolutions, the main issue here is that there simply isn't a need for federal involvement in this area of revising professional responsibilities for financial professionals providing investment advice. That area is reserved for the states, and under the proven state-based legislative and regulatory structure, tens of millions of Americans have been able to receive sound retirement assistance, products, and services from financial professionals who have consistently served the best interests of customers. Furthermore, 39 states have already adopted the NAIC's Stability in Annuity Transactions Model Regulations, addressing conflicts of interest in the promotion and sale of annuities. And as an agent myself, I know the importance of always acting in the best interests of my clients, but that doesn't mean that unnecessary federal government intervention here is appropriate. The state-based regulatory structure governing the manufacture, distribution, and sale of retirement-related financial products is effective and proven. With us here today as a young person to share with us, and when her name was first called, they told me that Beyonce was going to be here today. And then they turned around and says, oh no, her name is Bianca. So Bianca, I know you went last night and saw Beyonce, and I see you still bubbling over, but she is the National Association of Insurance and Financial Advisors. Thank you for being here today. We'll hold questions after she's finished. Come on.
Awesome. Well,
Somebody said sing us a song.
No. I will spare all of you that. But thank you, Mr. Chairman, for that colorful introduction that I was not prepared for. And well, good afternoon to everyone here. Thank you for allowing me the opportunity to speak to all of you today at my first NCOIL meeting. Oh, thank you. My name is Bianca Alonso Weiss, and I am representing the National Association of Insurance and Financial Advisors, otherwise known as NAIFA. NAIFA is proud to have collaborated with NCOIL to draft this resolution opposing potential fiduciary rulemaking by the U.S. Department of Labor. NAIFA supports a standard of care for securities and investments that both adequately protects consumers and preserves the ability of lower and mid-market investors to access affordable professional advice. NAIFA believes that a broad fiduciary approach could adversely impact this group from accessing investment products, advice, and services, and fails to recognize the inherent differences between the investment advisor and broker-dealer business models. Financial protection should not limit financial security options. NAIFA encourages regulators and policymakers to support the best interest standard to significantly enhance consumer protections without making financial products inaccessible for working-class Americans. Since DOL first began its fiduciary regulatory project, the consumer protection landscape in the United States has changed significantly. The first development was the 2019 promulgation of a rule by the Securities and Exchange Commission, referred to as Regulation Best Interest, or Reg BI. This rule provides strong protections to consumers who engage as registered representatives of broker-dealers on a commission basis to purchase products considered to be securities. The states are now adopting similar rules for insurance agents who recommend annuities based on the amended Suitability in Annuity Transactions model adopted by the National Association of Insurance Commissioners. To date, 39 states have adopted this rule or a similar version. NAIFA actively participated in the SEC and NAIC deliberations to require financial professionals to work in the best interests of their clients without limiting consumer choice or creating barriers that could prevent all Americans from accessing needed financial products, services, and advice. The SEC's Reg BI and the NAIC model protect our members' clients and all American consumers from potential conflicts of interest in these situations without returning to the failed DOL fiduciary-only policy. NAIFA applauds Representative Carl Anderson for spearheading and sponsoring this resolution and urges NCOIL to move adoption. We are looking forward to continuing efforts to ensure the DOL refrains from further rulemaking to revive or enact a burdensome fiduciary standard. Thank you all for your time.
Wow, thank you. You did excellent for your first time.
Thank you.
Are there any questions or comments from any of the legislators around the table? Okay, as the sponsor, I do note that some technical and editing changes to the resolution need to be made in the form of correcting the reference to the NAIC model regulation and other formatting changes. They are all non-substantial, okay? So now, the chair will now entertain a motion to adopt the resolution with those technical changes to be made. All right, second? All right. All in favor signify by saying aye. Aye. Those who oppose will vote nay. The ayes have it, and so it's ordered. Thank you, everyone. This resolution will now be placed on the Executive Committee's agenda for final ratification. Hey, we can dance right about now. All right, ladies and gentlemen, I've talked enough. I believe in sharing the work. So now, Senator Mary from Wisconsin is coming to do part 5.
Thank you. Thank you very much, Representative. Last on our agenda is an update on the activities of the Insurance Product Regulation Compact. With us here today is the Compact's Executive Director, Karen Shutter. Karen, thanks for being here, and please take it away.
Thank you, Vice Chair. And good afternoon, everyone. I'm very excited to be here. I did look up before I came up here that for those of you that miss Beyonce, apparently Kansas is playing tonight, which is the state that I'm from. So, well, first of all, the Insurance Compact, NCOIL has been a longtime supporter, even before it was developed. You worked side by side with your regulators to draft the Insurance Compact, as we call ourselves now, and to really help modernize the product approval process for life, annuities, long-term care, and disability income. These are products that compete with your banking and securities products and has historically been very inefficient to go state by state to get those filed because they're really the same product. You can take them and move to another state or move into your state. So unlike your homeowner's auto, these are really mobile products and conducive to uniformity, collaboration among the states. Also in the 2000s, there was a period of time where there was the threat of federal preemption. So states came together through NCOIL, through the National Conference of State Legislatures, through the NEIC, National Governors Association, NAG, and created this insurance compact. So for many of you, this compact has been in place in your state for many, many years. You should be very reassured that you have active legislative participation in our compact. What we do is states come together, develop the product requirements for those products I mentioned. Companies come, make one filing to us. We give it a very thorough review. We have many credentialed actuaries, as you can tell from our budget. We look at those products very carefully, and once they have to meet compliance, and then they can be used in your states. As I said, we have a very active legislative committee. We have the NCOIL president, Representative Ferguson, who sits on our legislative committee, the NCOIL vice president, Representative Oliverson, the NCOIL past president, Representative Lehman, and we also have Assemblyman Fryman from New Jersey, Senator Fine from Illinois, Representative Dunnigan from Utah, and Representative Kennedy from Rhode Island. It was 1 year ago that NCOIL reinforced their support for the compact. We've had one legal challenge to the compact, and I think it really reinforced how important the compact was. And so NCOIL came forward and recognized that this compact was one that Congress did, not directly but impliedly gave consent that the state should handle the business of insurance, especially in this area. So I want to give you an update of where the compact's been in that past year. First, I have amazing news to tell you. We have a new member to the compact. So we're now 47 compacting states. I'd love for you all to give a round of applause to Senator Klein, because North Dakota is joining the compact, so on August 1. Thank you. Really appreciate him sponsoring the bill along with his House counterparts. I had the pleasure of going to Bismarck twice this year. It was great, and it was a very active discussion. So very supportive. Again, legislature support could not be more important here. They will be joining August 1, and there'll be an official, companies can use the compact on August 16th. We have 47 compacting states, so it's the majority, more than the majority of states that are in the compact. And let me just give you a quick overview of some of the product lines that we're right now talking about, just so you know they're very relevant. We have 100 plus uniform standards across all of our product lines. We're just coming on with Group Whole Life, so that's a new product line for us. And we're working through, and you might have heard this, index-linked variable annuities. These are kind of the hybrid product that have been out in the marketplace for 10 years. They don't really they act like a variable annuity, but they don't quite fit within that schematic. So we're working on standards for that because that's a big and growing product in your marketplace. We're also going to work to accommodate non-employer groups so that companies can use compact products for those associations, those affinity groups. Today, they can only use our standards for employer groups. The other thing I wanted to mention is compact roundtables, because some of you around the table have attended those. We've had 3 in the last year. We are going to have another one on October 25th in Omaha, Nebraska. So we very thank you to Representative Ferguson, Representative Lehman, I believe Representative Dunnigan, and Tom and Will for joining those roundtables, because they bring together commissioners, regulators, consumer reps, state legislators, and industry to talk about what's going well about the compact and what can be improved, how can we further serve our state. So we're actually talking about that now. not only can we do the work that you've brought us together to do, which is to approve products under very thorough standards and issue in that state, but can we use our expertise to help states in other areas? So we'll be talking about that and keeping you apprised of that. Finally, we're having our in-person meeting. We tried to have those along with the NEIC in-person meeting so that minimizes travel. We're having that on Tuesday, August 15th. Unfortunately, that conflicts with the NCSL meeting, so for those legislators on our legislative committee, we're working to get an ad hoc room at NCSL so that you can participate in our call if you're available. That concludes my update. I'm happy to answer any questions.
Thank you, Karen. Are there any questions or comments from any of our legislators? Representative Lehman?
Thank you, Madam Chair. Karen, thank you, and it's really been great working with the IPRC. You mentioned there are 40, with the addition now of North Dakota, there's 47 states. Who is not a member? I mean, I know, but it'd be nice if maybe the room knew.
I can reiterate that. So states that have never joined or haven't yet joined, I'll say that, are New York, California, and South Dakota, and Florida. So New York, California, and Florida, the big three. And then South Dakota, but I am going there actually in August to meet with them. They're going to put it on their legislative calendar. As North Dakota, both Senator Klein and Commissioner Gottfried said South Dakota always follows North Dakota, so we'll see.
I was going to ask Senator Klein to go down there and put some pressure on his colleagues.
I know. And then, as Representative Anderson knows, South Carolina did withdraw from the compact. They had some concerns about long-term care in their marketplace, and we hope in the next session or the session after that, they will rejoin and not participate in long-term care. But we work with our members when they have concerns. And we continue to work with those big three states, and hopefully going into more advisory adjunct services could give them a comfort level to come into the compact. Thank you for the question.
Any other questions? Well, Karen, thank you very much again. It's always great to have you here, and it's important that our organizations continue to work together. We very much appreciate it.
All right, we just happened to share the work with Senator Mary. Thank her very much.
You're not touching that last name, are you?
No, I'm not touching your last name at all. You all right?
That's cool.
Okay. Do you want me to just say Senator Mary F.?
You can just say Senator Mary.
Oh, Senator Mary, okay. All right, okay, we're good then, we're good. I just want you to know, Ms. Karen, thank you for all that you do. And all of us around the table, those new persons probably never met our insurance commissioner, Farmer. Well, you know, Farmer has retired, and we have a new insurance commissioner now. So we've got to let him get settled, and then we're going to go at it. But we want you to come to South Carolina. We start our new session January the 9th, 2024. And we want you to come to South Carolina, and we want you to beat the bushes with us so we can get it passed.
Thank you very much, Representative Anderson. We'll take you up on that invitation. And I should mention, we have a very good working relationship with Director Weiss, and before that, Director Farmer. So we can hope to work on that.
All right.
Weiss. Thank you. Sorry.
Thank you again. Thank all of you for being here today. Any other business? As y'all know, I'm a timely man, and let me tell you something. We are finishing up early today. Yeah. Thank you very kindly. No further business. Meeting stands adjourned. We're going to break for 5 minutes, and we're ready. Ready for you, right? The article committee? Ready for the article committee, so don't go far. Stay right in there.